welcome one, welcome all to the Sunday Night Deathburger Report. It ain't what it seems. Let's start it off and get this thing cranking. First, the Dow Jones, the most popular thing. As you can see, we kissed up against the yearly high, didn't quite make it. Everyone's getting excited, but let's start taking a longer look. We're at a strong resistance level, which will probably hold throughout this week and through the election as we head into new turmoil. Why do I say that? Zooming in on the 9-month level here, we had a death cross and a golden cross, but we're way overextended and overbought, and we have bad banana karma in the future. We did not get or hold the new high. We're consolidating here and probably going to roll over because too many people are uncertain about the Fed. On the 3-year chart, it's even more pronounced. You can see where we keep having lower highs on the weekly closes. I'm using weekly charts tonight instead of the big thing, and the downtrend is still confirmed. You have to sweat it out here. This is going to be a bad sign. I'm using the Dow just to give you some big picture perspective. When you look at the channel the Dow's in, it's even worse. We're still in a downtrend. We haven't broken above it. We haven't gotten above any key resistance levels, and odds are the worst case scenario, this one, is still possible, where we get back and get into the 7,000 to 8,000 level, which will cause mass panic and hysteria, and probably an even stupider or more moronic Federal Reserve reaction. Why do I call it that? The Federal Reserve is in panic mode right now. They think something bad's going to happen. They don't know why. Look at the S&P 500. Similar type of chart pattern. Not as pronounced as the Dow. The down channel is still quite pronounced, though, on the S&P 500. Still moving down. Odds are we're going to see the worst case scenario there. The problem with this one is, when you look at it, I'll add the purple rain, because that's what I call our president, because of his purple lips. When you add the president purple rain scenario to this thing, it's the worst case scenario if the downtrend extends to the lower purple line, the third line at the bottom of the chart. We see that, and this is a weekly chart once again, the S&P 500. It's almost identical, if not perfectly identical, to the Dow. All hell's going to break loose, and they're going to monetize at such a pace that it'll destroy the dollar completely, and I mean far beyond our imagination. But Goldman Sachs broke above key resistance. Everybody's going, hooray! Yes, the bananas are dancing. The Dow's getting excited. We still do not have a golden cross, though, however, and we had a very bad week for Goldman if you look at that red candle. I don't think it holds. When you look at the longest term chart available from the inception of the stock, it's still moving down on a weekly basis. So we have to see significant improvement, getting it up over the 187 level before anybody believes it. In the meantime, and that red line is the estimated PE ratio of it, it's still crap. That's all I have to say. I'm not going to get excited about it at all. PNC Financial has made the news because of all the mortgage crap going on. And if you look at this stock, it hit a major high back during the boom, recovered, and now has cratered. I think we have a long way to go, and I think that is a $35 stock. Only my personal opinion, just because I'm looking at the P/E ratio and the housing problems they have. JP Morgan, similar situation. They went out and bought Washington Mutual or stole it, or however you wish to look at it from a perspective of reality. JP Morgan is a $25 stock before this year's out if the market behaves normally. When I say that, I qualify that. You still have Federal Reserve intervention possible. Wells Fargo is in a similar situation. It is probably closer, I've got it at around $17. I think it could do a lot worse. It's trading well above the historical PE for a stock, price earnings ratio for a stock that is in garbage zone. We're in a recession, it should be a lot lower. SunTrust, same situation, except I think this one has a goose egg or acquisition written on it. And this is just my personal opinion, nothing against SunTrust. Don't take this as investing advice or anything, but SunTrust has a problem. And SunTrust's problem is it owns a lot of the southeastern United States real estate, and I think it's at least at a minimum a $12 stock. Morgan Stanley is your epic fail of the week. While everything else rallied this week and everybody was singing happy days again after the Wednesday crater, it didn't even get above the 50-day moving average. The gap is starting to widen and continue down on the spread between the 50 and 200-day moving average, an indication of a total technical breakdown of the stock. Investment banking in the United States is dead, and I don't know why anybody in their right mind would want to own this piece of garbage. But hey, you're an investor, it's your choice. Look at the long-term chart. It's a Monica Lewinsky stock. You can sit there and figure that out yourself. This chart is from bigcharts.com. The other ones are from stockcharts.com. If you can't understand what I'm saying by a Monica stock, go back and read the Clinton era, or you're too young to play along and you probably shouldn't be listening to this to begin with. These stocks are behaving in such poor fashion. It's what's going to lead the market no matter how high Apple or Google or Baidu goes. Regions Financial, to give you an example of the regional banking stocks, has absolutely been decimated from the high 30s, and now it's a single-digit stock. It owns a lot of Florida, Georgia, Alabama, areas that have been totally trashed in the real estate crisis. Unless jobs start to recover in the Sun Belt, this stock's not going to recover. And that's why I put on here a caveat that resistance for the final trade is somewhere around 0. The price-earnings ratio is irrelevant because it's a loser, it's losing money, and it still has a lot of real estate that really needs to be written off. And that begs the question, if we don't have real estate being acquired, we have problems in foreclosure, how are we going to recover? So where are the jobs, Willis? Where are we going to get jobs for these people to go to work? What are we going to do to put all of the unemployed people that are allegedly off the rolls, no longer contractors? Well, let's go become computer geeks. No. Don't think so. This is the Federal Reserve charts from Fred in the St. Louis Federal Reserve. As you can see, information services jobs have been in a steady decline through the last quarter and continue to decline as they have since the turn of the decade back in 2001, the first recession. We've been outsourcing the jobs. There's no more available. We're not growing that industry. So perhaps everybody's gone into the retail trade. Maybe we're all selling shoes and stuff at the mall. No. Well, maybe if we all get rid of enough people to get us back to the 1998 level, maybe we need to get our population reduced to that level, then we'll be fully employed in the retail trading arena. As you can see, we're 12 years down. Construction? No. We're back down to the 1996-97 level. Once again, a key indicator of our economic strength. What are we doing in construction? Well, without home construction, nothing is happening. Without commercial construction, nothing is happening. We've flatlined here at a little over 5.6 million jobs, but that's not going to last. That's going to fall off even worse because a lot of the jobs that have been picking up lately are being laid off because of the foreclosure mess and the lack of stimulus. We're all in the service industry now, right? No. We're back down to 2005 levels, and we started to decline again. So apparently the number of burger flippers needed to produce Big Macs and Whoppers, and not to discriminate, my favorite, the Steak and Shake double steak burger with cheese, has hit its maximum. And with the number of illegal aliens looking for work also, we're going to have a problem here, Houston, and this is not going to resolve itself. So no one's going to buy those houses, so the construction people stay out of work, and et cetera, et cetera. Trade, transportation, utility? No. We're back to 1997-98 levels. Now, unfortunately, the population is a lot higher than it was then, and once again, we haven't recovered. We're not adding jobs at any kind of pace that's acceptable, and the transportation industry is really hesitant to pile a lot of employees into this with the NAFTA trade agreement with transportation and trucking. The rails don't want to reopen their capacity. You can see a problem developing here. Durable goods. We're going to manufacture things? No, we're back down to about 1986 level. Actually, before the 1986 level. I just pulled it up from 1990 to now. As you can see, we're not making anything in this country, so the durable goods report is basically bovine scatology. We might be making more, but we're doing it with less people, which means there's not going to be any dramatic pickup in employment to speak of. What about non-durable manufacturing? The other side of this, non-durable manufacturing. Oh, we're back to levels not seen since the Great Depression, and we haven't recovered. I guess it's not important that we don't make paper plates, toilet paper, paper towels, lumber, seeds, things of those natures that we've been making in this country for a long time. To give you an idea about how bad this situation is, you really can't even detect that. That number isn't historically relevant until you realize who was president and where we were. Yeah, that ass clown. That ass clown was in charge when we had this. This is the worst number we've had in our current modern history because this ass clown sat there and helped institute the socialist system, which helped us get to this level where we set up the globalist society. With globalism, why make things here? And this ass clown goes down in history as a great American. But zero hedge hit on a key story tonight about quantitative easing. Read the story at zerohedge.com. The Fed needs to print $4 trillion according to Goldman. Goldman stock's not up because it needs to be. It's because it's a warning shot. If you think for one moment the Fed's going to get away with $500 to $750 billion in this quantitative easing announcement, you're going to see a 30 to 40% stock market decline and total panic and hysteria in Washington. I warn you now. Yeah, basically we're bleeped. We have to sit there and come out with quantitative easing 2.0, and it better be the biggest, the baddest. Quantitative easing 2.0 had better be something special, or we are going to see our economy get one of these. Yep, all 8 megatons. Until next week, this is John Galt for the Sunday Night Deathburger Report.